China has unveiled a bold new strategy, selling its massive holdings of confiscated cryptocurrencies. But this isn't just a sale, it's a calculated move to reshape the global digital asset landscape. The sales will happen exclusively through licensed exchanges in Hong Kong, positioning the city as a critical gateway for a new wave of capital. For years, the world wondered what China would do with the billions in digital currencies it seized. Now we have an answer. This marks a significant shift. While mainland China keeps its crypto ban, it's using Hong Kong as a sophisticated tool to engage with global markets. Beijing can now influence crypto without reversing domestic policy, a strategic masterstroke. Hong Kong's One Country, Two Systems framework is being leveraged to channel immense financial flows in a controlled way. The timing is no accident. Hong Kong has just finished building a robust regulatory framework for virtual assets, providing a secure environment for these transactions. China isn't dumping assets on an unregulated market, it's channeling them through a system it helped shape. This ensures the process is orderly, transparent, and aligned with China's long-term goals. The world is watching as China, once hostile to crypto, becomes a major player. This is about more than money. It's a power play on the world stage. By controlling the release of such a vast reserve, China gains a powerful lever to influence global markets. The implications will be felt for years, impacting investors, governments, and financial institutions worldwide. Hong Kong's rise as a trusted crypto hub is the result of meticulous planning and world-class regulation. The new stablecoin ordinance, effective August 2025, enforces strict licensing and one-to-one reserves for stablecoin issuers. The Hong Kong Monetary Authority now demands real dollars back every digital dollar, ensuring stability and trust. The LEAP Digital Assets Policy Statement 2.0, introduced in June, unifies licensing and encourages tokenized products like real estate and bonds. Amendments to the Anti-Money Laundering Ordinance in 2022 forced all virtual asset platforms to meet high standards, aligning with global norms. These regulations create a secure, transparent environment that attracts institutional investors. By providing clear rules and robust oversight, Hong Kong is both attractive to capital and resilient to risk. This regulatory clarity is exactly what's needed to handle the influx of China's confiscated assets. Hong Kong is not the Wild West of crypto, but a mature financial center for the digital age. It's now uniquely positioned to manage the world's largest crypto flows. China's liquidation of crypto holdings through Hong Kong will unleash a torrent of new liquidity into global markets. Liquidity is the lifeblood of finance. High liquidity means efficient, stable markets. By injecting billions in Bitcoin, Ethereum, and more, China will dramatically deepen the crypto market. This addresses a long-standing criticism: crypto's low liquidity compared to traditional assets. Larger trades can now happen with less price impact, attracting institutional investors. Higher trading volumes will create a virtuous cycle, drawing even more participants. Hong Kong exchanges will benefit first, but the effects will ripple globally. This surge could legitimize crypto in mainstream finance, moving it closer to the core of the global system. Importantly, this is a controlled release. China can manage the flow to stabilize or move markets as needed. This level of control gives China a unique position as both market stabilizer and mover. It marks a new era of structured, mature crypto markets. By channeling its crypto reserves through Hong Kong, China is becoming a digital puppet master. This power is similar to its dominance in rare earth metals. China can modulate supply and demand globally. If prices fall, Beijing can slow sales. If it wants to cool an overheated market, it can increase supply. This gives China a powerful tool to influence valuations and market stability. Beyond price, China can shape narratives and direct capital flows, attracting more institutional money to Hong Kong. China can now dictate terms for a significant portion of the global crypto market. This strategic control fundamentally shifts the balance of power in digital assets. A sovereign state is now an active, major participant, introducing new levels of strategy and geopolitics. The market will now react not just to tech or sentiment, but to Beijing's strategic decisions. China's proactive strategy creates a major dilemma for the United States. The US has also seized large amounts of crypto, but its approach has been passive, holding or auctioning assets without a broader plan. In contrast, China is using its holdings to build markets and project power. The US risks losing its leadership in global finance if it doesn't adapt. This may force Washington to rethink its crypto policy, moving from passive observer to active participant. The US could develop its own regulated channels for liquidating assets or supporting domestic crypto innovation. Regulators like the SEC and Treasury must move beyond regulation by enforcement and craft a forward-looking national strategy. If Hong Kong becomes the global hub for crypto liquidity, the US dollar's dominance in digital transactions could be challenged. More trading could be priced and settled outside the US system, reducing its influence. China's move is a direct challenge. The US must respond or risk ceding the future of digital finance. The next few years will determine who leads the next chapter of the global economy. The stakes are high and the window for action is closing. Will the US step up or fall behind? China's liquidity injection will deepen markets but also heighten volatility. When a huge new supply enters, even in a controlled way, prices can swing dramatically. Traders and investors will try to anticipate China's next move, leading to rapid buying and selling. This environment demands new risk management strategies and sophisticated tools to monitor liquidity flows from Hong Kong. Compliance departments will face greater scrutiny as trading volumes and cross-border flows rise. For businesses, the challenge is managing risk. The opportunity is profiting from higher volatility and demand for crypto services. Institutions that adapt quickly will gain a competitive edge. The market must mature, developing better tools for price discovery and volatility management. Regulated Hong Kong exchanges will play a crucial role in maintaining order. Those prepared for this new era of activity and risk will thrive. In the race to be the world's top crypto hub, Hong Kong now stands apart. Singapore's regulatory framework is strong, but its market scale and capital depth can't match Hong Kong's. Dubai is innovative but lacks a direct connection to a global superpower like China. Hong Kong's unique one country, two systems status makes it the perfect bridge between China's closed economy and the global market. This direct pipeline to China's crypto reserves gives Hong Kong unmatched liquidity and influence. Its long history as a financial center means it already has the talent, infrastructure, and trust needed for a sophisticated digital asset market. Hong Kong isn't building from scratch, it's adding a powerful digital layer to an established powerhouse. This combination cements Hong Kong as a market influencer with unrivaled control. China's strategy and Hong Kong's regulation are creating a new world order in digital finance. Hong Kong is rapidly becoming the world's dominant virtual asset hub, with real market impact. It's the sole gateway for China's crypto reserves, a trusted center for institutional capital, and a lab for financial innovation. This challenges the long-standing dominance of New York and London. The most important trades, and price discovery, will increasingly happen in Hong Kong, under its rules. Asia-Pacific gains a stronger voice in global finance. As Hong Kong's influence grows, it will attract more talent, capital, and innovation, creating a self-reinforcing cycle. New crypto benchmarks may emerge, just as oil is benchmarked to Brent or WTI. Hong Kong's success proves its value to Beijing, strengthening its position as China's financial intermediary. The city is now a powerful projector of China's financial influence on the world stage. The long-term impact of China's crypto power play will reshape digital assets for years. A major world power is now using crypto as a tool of national policy, setting a precedent others may follow. More governments could leverage digital assets for economic influence, not just auction them off. This will accelerate crypto's integration into mainstream finance, forcing institutions and regulators to take it seriously. The lines between traditional and decentralized finance will blur, spurring hybrid products and wider adoption. But state involvement brings new geopolitical tensions. Crypto could become another front in global competition. Policy decisions may be driven by foreign policy or security concerns, fragmenting the global market. The world is entering a new phase in the evolution of money and power. China's strategy has turned confiscated tokens into a tool of statecraft, with Hong Kong as its stage. The game has changed. The flow of cryptocurrency is now as strategically important as the flow of oil.